Good afternoon. This is John Roberts from Klingenstein Fields Wealth Advisors. We are preparing to start our webinar. It's just a minute after 2 o'clock, so we're going to let a couple minutes go by to enable people to connect by phone or by computer, and we'll be back with you shortly. Good afternoon, everyone. Thank you for joining us today for our webinar entitled Staying the Course in Uncertain Times. My name is John Roberts, and I'm a Senior Vice President and Portfolio Manager at Klingenstein Fields Wealth Advisors. I'm delighted to welcome you all to our webinar this afternoon. I hope everyone is healthy, staying safe, and finding ways to relax and enjoy the summer. Here at KFWA, a great team, diligent efforts, and up-to-date technology have enabled us to work from home effectively and efficiently, continuing to serve our clients at full speed. There has been a lot of news to digest recently, both financial and non-financial. There's evolving news every day about COVID-19 cases, treatments, and potential vaccines. Quarterly earnings reports from our portfolio companies and outside managers provide recent results and clues and insights about the future. There's news from the Federal Reserve about monetary policy and from our politicians about fiscal stimulus. US-China trade and other tensions are frequently making headlines. And of course, the US presidential election is just 84 days away. The markets are dynamic, and we all witness the daily pulse, changes in direction, and new trends. With so much information to digest, it is sometimes hard to know what to focus on and what to pay attention to. We have had a lot of good discussions with clients recently regarding whether and how to react to the current events by changing their portfolio strategies. Today, we take a step back to have a general discussion of what history has taught us about investing effectively and KFWA's approach to asset allocation and portfolio construction. Of course, each investor's situation, characteristics, and goals are different, and we recognize that there is no one-size-fits-all portfolio, but we do believe that a consistent investment policy and approach is critical to investment success. I'm going to begin with an update on developments regarding COVID-19, the markets, and the economy. After that, I'll turn it over to my colleagues, Jamie Steers, Director and Wealth Advisor, and Tim Lindsey, Director and Senior Advisor, for a discussion of why it is important to stay the course and resist reacting emotionally to the markets. After that, we will open it up to questions and look forward to any that you may have. If we get more questions than we have time for during the call, we will follow up individually to make sure they are addressed. During the call, you can submit questions anytime, one of two ways. If you're listening through your computer, there is a widget on the right side of your screen where you can submit questions, or you can email them to mildred.pallo@klingenstein.com. And her name is spelled MILDRED.PALO@klingenstein.com. So first, a brief recap of where we are, both nationally and locally here in the New York area regarding COVID-19. Coronavirus concerns have been brought back into sharp focus recently, as we have seen new cases rise nationally through June and July, with many states struggling to contain the virus in a post-reopening environment. Multiple states have paused or rolled back reopening plans amid concerns regarding sharp increases in the number of positive cases. Early indications are that these rollbacks are slowing the progression of new cases in many of the recent hotspots. In New York City, we officially entered phase 4 of reopening on July 20th, but indoor dining, which was listed as part of phase 3, has been suspended in light of what's going on in other states that eased restrictions on indoor dining and bars. In recent weeks, we have seen very promising news in terms of potential vaccines. Combined phase 1 and phase 2 results from a vaccine trial, an item developed by the University of Oxford and AstraZeneca, indicate both that the vaccine is safe and that it promotes an immune response. The next phase 2, phase 3 study will test this vaccine more widely against a larger group of people in different age and other cohorts to further assess both its safety and its efficacy. Other experimental vaccines from Pfizer, Johnson & Johnson, Moderna, and the Chinese pharmaceutical company CanSino Biologics all published results from their vaccine trials that appeared similarly promising. So there is a lot of optimism that one or more vaccines will be available by early 2021. So what lies ahead in terms of the economic recovery and the markets? Especially as California, Texas, and Florida are currently struggling to contain the spread of the virus, and these represent a significant share of U.S. gross domestic product. A report on second quarter gross domestic product announced last week showed a decline at an annualized rate of 32.9%, the worst decline in over 70 years. At the same time, the Labor Department reported that the number of workers applying for unemployment benefits rose again after nearly 4 months of decreases. We believe that the second quarter of 2020 should have been the worst of the economic downturn and expect a rebound in the third quarter of 2020. But that could change or be slowed by a new phase of the pandemic and how consumers and businesses respond. There is a lot of talk about the shape of the recovery, whether it will appear graphically shaped like a V, a W, a U, or shaped more like a Nike swoosh. Whatever shape it takes, any recovery is likely to show differently and unevenly across sectors and geographic parts of the economy. We are already seeing a V-shaped recovery in housing, where buyers are seizing on record low mortgage rates and often competing for suburban locations. U.S. vehicle sales rebounded dramatically after significant declines just 3 months ago, and used car sales are up as well. E-commerce is booming, witnessed by strong recent earnings reports from companies like Amazon and United Parcel Service. The shift to online retailing has been massive as the health crisis closed most retail stores for months, and some brick and mortar stores may never reopen. While travel, live entertainment, and other leisure industries may take much longer to recover, we have seen shifts there too, as Disney Plus added 60 million subscribers to this new service in just 9 months, an amazing achievement that took Netflix 8 years. On the weaker side, Boeing is slashing production of commercial aircraft, and the cruise line industry is shedding ships to adjust their business model for a post-COVID environment. These are just a few of the headlines from the daily barrage of economic news. We also track a wide range of aggregate statistics and other indicators to build and adjust our expectations about economic activity. Any analysis of economic recovery must begin with monetary and fiscal policy. The support of the Federal Reserve and the US government through stimulus, financial aid, directly supporting financial markets, and creating a general belief that they will do whatever it takes cannot be underestimated. The Fed has pledged to use the full range of tools to support the US economy, and recently announced that it effectively abandoned its strategy of preemptively lifting interest rates to head off inflation, a significant change in policy that has been in place for many decades. In addition, in mid-June, the Fed said they would start buying corporate bonds and exchange-traded funds, helping to maintain stability in these markets. The Fed has clearly stated that they have virtually unlimited resources to support the US economy. They have already provided for a truly massive and unprecedented stimulus program. The sum of the fiscal and monetary stimulus this year in the United States is equal to more than 20% of our GDP, and likely to go even higher. Interest rates are historically low and likely to stay low, at least through 2022. The recent yield on the 10-year US government bond was 0.57%, compared to a dividend yield on the S&P 500 of approximately 1.78%. Overseas, the European Central Bank has also signaled that it will go above and beyond to ensure that markets function properly and that growth is restored. This shows greater coordination and commitment to economic recovery in a unified response from the European Union, which it previously lacked. So far, 2020 S&P 500 earnings reports, second quarter 2020 S&P 500 earnings reports are down 34%, but have exceeded expectations by 23%, and projections for the second half of 2020 are improving. These are impressive results considering how much bad news was anticipated. On the jobs front, after losing 25 million jobs between February and April, by the end of July, there was encouraging news that 10 million jobs were added. The unemployment rate in July reached 10.2%, down from its April peak of nearly 15%, but still far above the lows of 2019 and early 2020, which hovered around 3.5%. We are watching to see how increases in COVID-19 cases and potential slowdown or reversal of reopening impact employment and forecasted positive third quarter economic growth. We are often asked why the markets have been so strong. So far, 2020 has been a very unusual and surprising year. It is hard to imagine that just this past February, the markets were making new highs, only to see a 40% drop in a few weeks' time as the pandemic spread worldwide. Since that March 23rd low, the broader market has made a remarkable recovery, with the S&P 500 now within 1% of its February peak, and the tech-heavy NASDAQ index recovered to make recent new highs. There is no single answer to that question, but some of the contributing factors include the unprecedented global easing and support to sustain economic activity, the massive increase in the money supply across all major economies. Bond yields declined to record lows, which tends to push up other asset prices. And inflation remains low, boosting returns on investment. These factors enable investors to look beyond the difficulties of 2020 and focus on the return to global growth. Other factors include overreactions, innovation, and the acceleration of trends. The markets overreacted to dire estimates of the initial impact of the pandemic on the economy. Many sectors of the economy have proven to be innovative and adaptive to new ways of doing business. Remote work is becoming normal operation for all types of organizations and industries changing their business models. Many companies, including KFWA, are extending working from home into 2021. Corporate travel budgets are expected to be very constrained, even as the economy improves. The pace of adoption of new technologies like cloud computing, direct-to-home delivery, and new forms of media and entertainment are all accelerating. There can be a market correction anytime, but when we think about prolonged bear markets, some of the key ingredients that we would expect are bond yields going up. Today they are at historic lows. Investors becoming overly optimistic. The average investor has actually been pulling money out of the equity markets. Inflation increasing, causing the Fed to tighten credit and raise short-term interest rates. Both seem unlikely to happen until 2023 at the earliest. Therefore, we expect equity prices to continue to trend higher over the next few months based on more economic support. Despite the apparent failure of negotiations last week for another U.S. stimulus package, we do expect that more stimulus will be provided. Earnings reports for 2020 exceeding expectations and the portent for better results going forward. And encouraging reports from drug companies about treatments and vaccines, leading to a time when the health-related concerns will fade as a constraint on all of our lives. We will continue to keep a close eye on COVID-19, the economy, and the markets to keep you informed regarding what's going on and our perspective on what it all means. With this lead-in, let's get to what Jamie and Tim are going to discuss today. With so much noise and so much information coming from so many sources, how can investors know what is important and what is not? And at the core of it, what to do with their portfolios. We'll be using a few slides to illustrate the discussion. For those that have joined by computer, you will be able to see them. A recording will be available soon after the call. We will send out an email with information on how to access it. So I'll pass it over to Tim.
Thank you, John. That was a great introduction. Hello, everyone. Thank you for joining us. My name is Timothy Lindsey, and I'm a director and senior advisor at Klingenstein Fields. I advise private clients as well as nonprofits. My responsibilities include asset allocation research and implementation, as well as oversight of our third-party investment managers. As John mentioned at the top of his remarks, we've had numerous conversations with clients over the last several months to discuss appropriate portfolio positioning during the various phases of this volatile year. These discussions have covered topics large and small, micro and macro. But there's one area we've discussed with more frequency than perhaps at any other time than since the global financial crisis of 08 and 09. And if I put it into a question, it would be, shouldn't we just sell the portfolio's equity and risk assets, either all or substantially, and hold cash and short-term bonds until things return to normal? And so while we think shorter-term tactical adjustments can be prudent and beneficial to a portfolio, we firmly believe that broad asset allocation decisions need to be strategic and long-term focused, and importantly, made in the context of a well-designed investment policy that is customized to the requirements of each client. And this applies to families, family partnerships and LLCs, individuals, nonprofit entities, any significant pool of assets regardless of the entity type. And so I'll answer this question. And that is, we believe that is almost never a good time to engage in what we would call market timing, or a sweeping decision to materially liquidate your investment portfolio in the hope of reinvesting at a more attractive reentry point in the future. We fully understand that these are unique times, and even as seasoned investment professionals, we're not immune to the emotions and feelings you may have experienced during this roller coaster of a year, and it's only been 7.5 months. The fact of the matter is it could be extremely difficult to maintain investment discipline when the markets are volatile and there's so much uncertainty. Adding to this anxiety, we have access to a fire hose of information 24 hours a day, 7 days a week from around the globe. So it's hard to resist reacting to what we see and hear on a day-to-day basis, and that's true even during normal times. On our first slide, we show the results of a 2019 Charles Schwab survey of 300 advisors. It ranks the emotional biases that advisors cited as affecting their clients' investment decisions. As you can see, the top 4 biases are recency bias, loss aversion, confirmation bias, and home bias, or also called familiarity. I'll give you a brief overview of each of these 4 and how they impact investment decisions. Recency bias was cited the most, which is not surprising, and it's probably particularly prevalent right now. Recency bias is when recent events or experiences tend to have an outsized impact on the decisions we make today. It is when we believe that what has happened most recently will continue to happen. And this is what makes us want to buy when the market is up and sell when the market is down. And oftentimes these are exactly the wrong times to take those actions. Next is loss aversion, one I'm sure many people are familiar with. Simply put, loss aversion means that the pain of losing $100 is greater than the satisfaction you get from making $100. And you can add as many zeros to this example as you wish. So you'll do what you can to avoid a loss, irrespective of the potential for future gains. And as a result, you may act in a fashion to reduce near-term risk, such as liquidating assets because you're worried about further losses, but only to miss out on the longer-term gains. Confirmation bias occurs when you want an idea, opinion, or situation to be a certain way, and then you find supporting information to validate your view. You also intend to interpret input. You tend to interpret input in a way that supports your view and perceive information that is contrary to your outlook as false or insignificant. Confirmation bias is more prevalent during times of anxiety and stress. And for example, if the markets are volatile, you may have an opinion regarding what you should do, perhaps that is to sell. And then you'll seek out information, data, expert opinion to confirm that you're making the right move. And the fourth, familiarity or home bias, leads us to make decisions based on our own experiences or things with which we are more familiar. This can lead to focusing on investments that we feel we know, and it presents a couple of potential drawbacks. This bias might lead us to take on more risk through concentrated company holdings or legacy positions. Additionally, home bias might lead us to neglect investments or asset classes that can add diversification and long-term return benefits, such as small cap and emerging market equities. This is a long list. There's 15 entries here, and I won't go through the rest. My main point is that it's difficult, especially during times of market uncertainty, to avoid emotionally driven investment decisions. So let's get back to that earlier question. Why not just sell our risky assets when things look bleak? Well, it's difficult, if not impossible, to accomplish successfully, even setting aside the tax implications where relevant. In order to successfully execute a market timing approach, you need to correctly time not just the exit, but also the reentry. And it's oftentimes the reentry point that trips people up. Our next slide presents a hypothetical comparison. The line at the bottom of the chart shows the growth of $1 million invested in the S&P 500 index over 15 years through 2019. The lines above show growth of that same $1 million, but under different scenarios. What if you missed out on the best 30 days of the market, or the best 20 days, or even just the best 10 days? As you can see, missing out on the 30 best days over the last 15 years would have resulted in a decline in value, while staying fully invested would have more than tripled your investment. Even missing out on just the 10 best days would have reduced your value by roughly 50% versus having been fully invested. So when do these best days tend to occur? And on our next slide, this might seem counterintuitive, but many of the best days in the market are historically during not during bull markets as you would expect, but during bear markets or soon after a bear market has ended. This chart shows the 15 best days for the S&P 500 index since 1950. The common thread here is that each of these days occurred during periods of market stress. Interestingly, if you look in the yellow highlight, 4 of the 15 days occurred just this past March. Now, I'll concede that there were some pretty awful days for the market before and after these dates that you see here, but history shows that market rebounds can be swift and from our experience are generally as unexpected as the market declines. Much of this might seem academic, I'll admit, and charts like these are cold comfort when stocks are sliding 35% or more, such as we experienced in February or March of this year. However, the consequences of getting it wrong with short-term market timing are real, well-documented, and potentially substantial, as you will see in our next slide. This schedule shows the 20-year annualized returns of various asset classes, along with 2 diversified portfolios, which you can see in the blue shade. One portfolio is 60% equity, 40% fixed income. The other is 40% equity, 60% fixed income. I'll note that both of these include sub-asset class diversification. There's a couple of interesting aspects here. The first is that the blended portfolios capture a significant majority of the return of the S&P 500, which you can see in green. But, and more importantly, I'll call your attention to the orange shaded bar. This is the return of the average investor, which is an estimate based on the observed cash flows into and out of the mutual fund industry. Over the last 20 years, the average investor had an annualized return of just 2.5%, a return that barely kept up with inflation of 2.2%, and one that trailed almost all other asset classes. This 2.5% return is also less than half the return of either of those blended portfolios. So clearly, the average investor is not achieving a market rate of return. And we would suggest that it is due to a combination of emotionally driven investing and also investing without a strategic investment plan. So I've spent all my time here telling you what we shouldn't do. So let me now hand things over to my colleague, Jamie Steers, who will review with you what we do, the approach we take at Klingenstein Fields to help you achieve long-term financial success.
Thank you, Tim and John, and thank you all for taking the time to join our call today. My name is Jamie Steers, and I am a Director and Wealth Advisor here at Klingenstein Fields. In my role, I work very closely with our clients and their external advisors to deliver a fully integrated and highly customized wealth solution. On a day-to-day basis, I keep a constant pulse on our clients and their investment portfolios. As a part of this oversight, it includes meeting with each of our portfolio managers regularly to review individual client accounts in depth and try to identify ways that we can enhance, adjust, and optimize how assets are positioned. It has never been more important to build a portfolio that has the greatest potential to capture opportunities, weather uncertainties, and achieve long-term goals. With that in mind, I thought I would take some time to highlight how we construct investment portfolios here at Klingenstein Fields and offer some perspective into our process and philosophy with regards to developing a diversified asset allocation framework. Next slide. The long-term goals that each of our clients have are always reflected through the investment portfolio, which is why our process begins always with us spending a significant amount of time getting to know each of our clients intimately and gaining a thorough understanding of their situation. This initial discovery phase is the premise behind the actual creation of the investment plan and the tactical and strategic asset allocation targets that we seek to maintain over time. Once this plan has been reviewed and mutually agreed upon, we will then begin implementing the portfolio and allocating to the underlying investments that we've identified as appropriate. Post-implementation, we are constantly monitoring and reviewing how the assets are positioned and will make periodic adjustments to the mix of assets to keep the long-term goal and current needs in balance. Next slide. I think it is important to highlight some of the questions that we asked during this initial discovery stage and why the answers to these questions are the driving force behind the development of an investment framework. These questions might include, what are you trying to accomplish? How much time do you have to accomplish your goals? Do you have ongoing spending needs that will have to be satisfied from this pool of assets? How much risk are you comfortable taking in order to achieve your goals? What is your current income? At what age do you expect you might want to retire? This is just a flavor of the many questions that are being asked during this phase of our process. All of the information is captured and documented within an investment policy statement that details each of the factors that we've learned during our initial and ongoing conversations together. Next slide. The policy is incredibly flexible, and it's regularly reviewed to ensure that any changes to your situation are incorporated into the plan. The investment policy statement is a critical part of our ongoing process as it documents our understanding of your goals and needs and ensures that they are aligned with how you would define them. Hence the importance of having this as a written policy that requires both your approval and ours whenever adjustments are made. Your investment policy is intended to provide a well thought out framework from which sound investment decisions can be made. Without a policy in place in times of market turmoil, investors are often inclined to make impromptu decisions that are inconsistent with the prudent investment management principles that we believe in. Historically, asset allocation has been the primary driver of a portfolio's performance and risk, but how to properly allocate across asset classes is driven by the factors that are captured within the policy and that we lean upon heavily as we make decisions. Next slide. So let's pivot a bit to the actual development of the asset allocation framework, starting with some historical context. It is exceedingly difficult to know who the winners and losers will be among asset classes from year to year. As you can see in this chart, the winners from one year may be at the bottom in terms of performance the following year, and vice versa. By investing in different asset classes in a way that aligns with the investor's risk profile, goals, and other requirements and circumstances, the portfolio has access to a range of asset categories that serve different purposes in providing opportunity for return and managing risk. In addition, diversifying within a single asset class like equities, for example, is equally as important. It is not uncommon that some portfolios may be comprised predominantly of domestically oriented public equities. These portfolios often have some portion of assets in either cash or fixed income, but beyond that, there's limited exposure to other geographies or alternative investments like hedge funds and private equity. In this scenario, it is equally as important to diversify within, which can be accomplished by ensuring that the mix of stocks are adequately spread across industries, sectors, and company type, as it helps to avoid over-concentrating investments and inadvertently exposing a portfolio to undue risk. Rebalancing periodically can also help to mitigate over-concentrated positions or asset class exposure, and will further maintain an investment discipline that ensures that the assets are always positioned in the way that we've planned to work towards the end goal. Without rebalancing over time, a portfolio's asset allocation typically will drift and become compromised by larger than intended allocations that may have appreciated over time. This often occurs within equities when good companies can generate substantial returns in favorable market environments for their businesses. To avoid that risk, establishing, monitoring, and adjusting assets as needed can help put the portfolio back into alignment with the agreed upon policy targets that provide the best potential to generate the returns that we need to meet the short and long-term goals that you have. While these principles underlie our overall investment approach and philosophy, it is crucial to know that there is no one-size-fits-all model, and every investment plan is going to look different. I will close with one final point on this topic, and that is that all investments involve at least some level of risk. But some can be far riskier than others. This is why combining assets with different risk return profiles can dramatically improve a portfolio's efficiency and reduce undesirable outcomes. While riskier investments like equities offer a much higher potential for loss compared to low risk categories like fixed income, they can also bring with them a higher potential for gain. Conversely, while low-risk investment categories like cash and fixed income bring a lower potential for loss, they also have a much lower potential for gain. This concept is referred to as the risk-return relationship. A well-constructed investment plan will account for the behavior of riskier assets during the good and the bad times. Striking the right balance by taking on only the amount of risk that is needed can help capture the rewards that are offered by up markets, but also withstand and shelter assets during periods of down markets and volatility. As you can see on this page, each asset class differs with regards to its expected long-term return potential, but as highlighted on the previous slide, in any given year, actual results may vary widely from long-term averages. We evaluate the balance of risk assets with the returns that a portfolio needs in order to satisfy spending and various other factors. To mitigate uncertainty in outcomes over a long-term time horizon, diversification is of course important on some level, but it's particularly important to portfolios that are utilized to support spending needs, as they can be compromised if too much risk is taken on at any one point in time. In sum, this all comes down to each of our clients' unique goals and objectives and our ability to create a highly customized solution that meets those objectives over time. How we define and shape asset allocation and what that means as far as diversification is almost always going to look different from one client to the next. Due to the highly customized nature of each portfolio that we manage, the importance of having regular communication with your advisor is critical for all of the reasons that I've mentioned above. When changes occur, reaching out to your advisor in a timely manner would be a prudent practice to implement, as it helps us make the adjustments that are needed in order to keep your goals and objectives on track. Similarly, everyone on the team here at Klingenstein Fields strives to offer full transparency to our clients at all times, and we are highly proactive in communicating any potential investment activity that's being considered for your account, or any shifts in our views internally that might influence our decision making. Ultimately, each of our clients' financial plans, extending far beyond just the pure investment planning, is built by your goals and your dreams. Investing is one key component of planning because it is the best way to grow wealth over time. But we believe a comprehensive financial plan also manages risk to ensure that you have money when you need it, no matter what's happening in the financial markets. I hope this offered some helpful insight into our approach and how we develop portfolios that are highly unique and customized to each of our clients individually. With that, I'll turn it back over to John before we open it up to questions. John?
Thank you, Jamie and Tim. That was a great discussion of the importance of a long-term strategic approach to investing. As we discussed, in these times of uncertainty, it can be all too easy to get caught up in emotions and biases. Klingenstein Fields Wealth Advisors is here to help you maintain investment discipline and strategies that will help you stay on track to achieve your short and long-term goals and objectives. We always welcome the opportunity to hear your thoughts and concerns and share our thinking and approach. We encourage you to reach out to your advisor with any questions on your individual portfolio. At this time, I'd like to open up the call to questions. Again, if you're listening through your computer, you can submit questions through the widget on the right side of your screen, or you can email questions to mildred.palo@klingenstein.com.
Great,
Ellen?
thanks, John. We've gotten a number of really good questions. As John said, we may not get to all of them, but rest assured, someone will be reaching out to make sure you get an answer to a question if you've put one in. The first one I am going to send to Tim. We've gotten a number of questions about different types of asset classes and style and things like that. One is particularly on small caps. They haven't performed as strongly. Do you feel that now is the time that you all are considering selling, or are you thinking about buying? So view on small caps.
View on small caps. So small caps, if we go back the past 5 years, small caps have had less than half the return of large caps. So it's been a tough 5 years. Part of this has to do with the fact that large caps, have been supported by the returns of a relatively concentrated group of mega cap tech-focused companies. So that's part of the reason for why small cap has trailed. I think if you look back longer term, over 20 years, I know that small caps outperformed by a meaningful amount over large cap. And if you look back further still, small cap does outperform. Our expectation is that small caps should outperform. And if you look at the universe, you're talking about thousands of companies. The issue that you have even during a normal period is that I'm going to say roughly 40% of the index is going to be comprised of companies that don't even have positive earnings in any given quarter. So, and if you look at it from a manager perspective, the dispersion of returns is enormously wider across the small cap spectrum than large cap. So there's always a lot of opportunity there. And again, so it's hard to define a market when it's thousands of companies that are quite diverse. Having said that, and you look at what we're facing at with the COVID-19 restrictions, small companies on average, I would say, they're going to feel these dislocations more acutely than larger cap companies that have more resources and more access to the capital market. So our perspective is you want to own small caps, but probably at a policy weight, no more than a policy weight for most people.
Great. That's a great answer. Another great question, similar, I'm going to send also your way, Tim. And this is about style, growth versus value. Similarly, growth has outperformed value for the most part since the financial crisis. What is Klingenstein Fields' perspective? Are they now poised to outperform, or do you see the trajectory continuing?
Well, they've had a good couple of days. We'll see how long that lasts. So, I mean, value versus growth. This is a topic that has been a high-ranking consideration for several years now. If you go back over the past, I'm going to say 7 years through July, this is off the cuff, but the annualized return of the 1,000 value index is roughly 7%, and that's relative to 17% for the 1,000 growth index. So on a cumulative basis, you're talking about returns on the 1,000 value of about 60% versus 200% for the 1,000 growth. These are spreads that we've just never seen. And if you look at it just from a year-to-date perspective, growth stocks are outperforming value stocks. At one point last week, it was well over 30%. We're probably roughly 29 to 30% today. And so in the near term, coming into this year, value looked like it had a shot to outperform growth. We saw manufacturing starting to improve in the latter part of the year. Valuations were reasonable. Growth had been on a nice run for such a long time. So it seemed like value would have a shot in the sun. And obviously with the COVID-19 crisis, that thing, it just completely went reverse. So, and it makes sense what we're seeing this year. Value stocks are more concentrated in sectors that have been hit hardest by the lockdown. So you're talking financials, real estate, industrials, energy stocks. That's where value managers tend to go. And so, can that continue? Will that continue? Part of this depends on the restrictions and how soon we're able to lift restrictions successfully and face down this virus. So that's a difficult thing to consider, irrespective of valuations. On the flip side, when you consider the fact that we're dealing with low, as John mentioned in his remarks, we have low inflation, we have low interest rates, we have once we sort of normalize the economic conditions over the next couple of years, I think the expectation is low to moderate growth expected, and so those are conditions that favor growth. And so what we would say is, you want to maintain some exposure to value stocks. And if you look at the 1,000 value index, it's Berkshire Hathaway, J&J, JP Morgan, Intel, Disney, Cisco Systems. you need to have exposure to these stocks, but we would not overweight them. Generally speaking, we're tilting the portfolio towards quote unquote core and growth stocks, just so that we're not overloaded in stocks that have somewhat of a binary outcome vis-a-vis the COVID-19 virus.
And I would just add a small point there. And in addition to highlighting the headwinds that industrial and financial companies have faced in recent months because of the economic slowdown induced by the health crisis, there has also been tremendous acceleration of trends relating to technology and technology-enabled businesses, and so that the growth sector has experienced an acceleration of its growth. So the fact that there is a wide divergence from an historical point of view does not necessarily mean that it has to be reversed immediately. We've been waiting a long time for that, and it hasn't happened yet. So that certainly argues for spreading and diversifying one's exposure to these two sectors.
Great, thank you. Thanks, Tim. Thanks, John. Good answers. Another question. This one is for you, Jamie. A really good question. You talked about the importance of regular communication with the firm so that you're up to speed on my situation and anything that might have happened that's significant, because that could affect my short and long-term investment plan. Could you give me some examples of those types of events or situations and how you might respond to them? In other words, when do you decide how to adjust a plan in response to either a temporary or permanent change in my situation?
Thanks, Ellen. That's a great question, and it's a very important one for us to address, because it's correct that any and all updates to your circumstance are highly important to how we approach your investment plan and beyond. I think, a few examples that are financial related and significantly related to your financial situation would be something along the lines of one of your children getting married. You might not have to be funding the wedding per se, but that in itself has indirect correlations to how we're making decisions and how potentially we're structuring trusts or entities in your children's name. There's also the inevitable situation where somebody is having a new baby. It might be your first grandchild, and you're looking to put plans in place to fund their education, as one example. Or you might have lost your job and we have to adjust for liquidity needs that were unexpected in the portfolio and try to generate more liquidity for day-to-day spending. Or the opposite could occur, where you have a new job and you're earning twice what you were previously, and so we'll have to plan around that and ensure that we're using that excess liquidity to allocate into the investment portfolio. There are a number of factors that really span from what may feel trivial up to something as significant as selling a company and coming into newfound wealth that you are looking for us to manage and invest and structure in the optimal way. Even if the situation itself isn't financial, I think the knowledge and the connections that our firm has across our team are very expansive, and there are other ways that we can help benefit your situation. Or if you're dealing with an issue, say a medical issue as an example, there are a number of people at our firm who might be able to help and have experienced similar situations with other clients. So I think, at the end of the day, there's a wealth of knowledge that exists at the firm, and we try to apply that knowledge and do everything in our power to help you navigate situations as they come about. So there's no too small or too large of an issue or update that you're experiencing in your life that isn't worth picking up the phone and just keeping us up to speed on. I think the more communication that we have with you and the more we know about your situation, it's the better. And it all indirectly and directly kind of informs what we're doing for you on the financial planning side.
Great, thanks so much, Jamie. We have time for a couple more questions, and we apologize to any that we aren't unable to get to. We will definitely reach out to you with answers and conversation. I'm going to send this one to Tim. What is your view on international stocks, particularly emerging markets?
You're picking on me, Ellen.
I know. Yeah, I feel
So-
very powerful, but I know you can handle it.
Much of the response that I had for small cap is in many respects similar to the international markets. I would say that the developed international markets have had the worst returns over the past 20 years. I'm looking at returns here. So international developed, and obviously that's being driven by Europe, that's being driven by Japan. The indexes have been challenged. Emerging markets have fared better. Emerging markets have actually outperformed the U.S. markets over the past 20 years. They're quite different, though. Internationally developed companies are generally roughly in line from a volatility perspective with U.S. equities. European stocks in particular tend to have a better yield than U.S. equities. In the emerging markets, it's quite different. You have to strap yourself in and get ready for the ride because it can be quite volatile. I do think that you have to look at them separately. For example, emerging markets are not what they were 20 plus years ago. I remember starting off in 97, my career right around the time of the Asian currency crisis. Since then, emerging market companies have developed a far more advanced financial and banking capability than they had back then. They're more self-sufficient than they have been at any time. The index itself is very different. There's a lot more tech than even the non-US developed EFI index. And so there's really good opportunities. So if you look at the emerging markets in particular, it includes companies like Samsung and Alibaba that are powerhouses, and also regional players, for example, like South America's Mercado Libre. I'm just pointing these out as substantial companies that are going to be here for a while. And so there's really interesting options out there in the emerging market space. For the European and Japanese market, you're making the same case that you would as if you're looking at U.S. value. Generally speaking, you're talking about much cheaper companies. The EFI index, which again is the developed non-U.S. index, doesn't have a whole lot of tech. It has a lot of industrial. It has a lot of financials. So the same obstacles that U.S. value stocks face are those that are faced by EFI companies. And so I think, again, you're talking about thousands of companies. And if you have an active investment manager to find the attractive opportunities among those thousands, I think philosophically it makes a whole lot of sense to have some exposure there. But having said that, the similar challenges that U.S. value stocks face, where again, low interest rates, low growth, it really does come down to reforms that they can make in Europe, and allowing their companies, and corporate boardrooms in Europe, looking at what's happening in the United States and around the world, realizing that this might be a sink or swim situation for them, and giving them sort of the incentive to modernize in a better way. So there's a lot of potential there if you're looking at it from a 5-year perspective. And again, I don't think you could simply abandon an area of the equity markets that comprise many thousands of companies.
Great, thanks, Tim. That was such a great answer that you've dissuaded me from torturing you anymore. We'll end with the last question, and I'm going to send it over to John, at least to start with. And we did get a couple questions around alternative investment classes, and the fact that given that they have a long lockup and long length of time to exit, sometimes they can be investments that perform well in downturns. And just sort of looking at what views are at Klingenstein Fields for those asset classes right now in terms of what's going on.
Thank you, Ellen. There are many different types of so-called alternative assets, and for wealthy investors who are thinking about intergenerational legacy, we often recommend some exposure to different types of alternatives. As you noted, many of those types of investments, and they can range from commodities to hedge funds to other types of private funds such as venture or buyout funds, as well as fixed income funds in a variety of different areas, real estate, for example. Many of those are organized in structures that are not liquid and require investors to commit to them and have only very occasional annual, for example, opportunities to redeem, or in many cases, you make an investment and you're in that investment for 10, 12, 15 years with no possibility of redemption to liquidate it. There's such a range of opportunities there that it's hard to focus particularly on the characteristics and advantages of them as a group, because it varies quite a lot. And often the fact that there is no liquidity and there's no current price, and the volatility that is experienced in public markets does not appear to be present, doesn't mean that it's not there. And the risks of those kinds of lockups are quite substantial. So, for example, when earlier this year, when the world changed completely, there were many forms of private investments, alternative investments that had their underlying circumstances materially changed. And I'm thinking, for example, of the broad category of opportunity zones, which was a very popular investment last year, in the last couple of years, because of new government regulations, encouraging investors to invest in particular areas geographically that were designated as opportunity zones. And the range of investments tended to be real estate oriented, but had other characteristics as well. So to the extent that the world changed, the economic underpinnings of those investments changed. And did you experience volatility? Well, not really, but you may have experienced real loss. In any case, broadly, we find that alternative investments are worth consideration, and for a relatively modest portion of a wealthy investor's portfolio, that there can be attractive opportunities. And the areas that seem prospectively most interesting at the moment are venture capital and other private funds, and potentially some private funds in the distressed debt areas. We're not involved in that directly, but another area of interest. And maybe, Tim, you have some thoughts about some of the funds that you see.
Sure, definitely. You know, in the hedge fund space, you can break it up into different subcategories, but even if you do, the risk return parameters that you see from portfolio to portfolio or from firm to firm are vastly different. And so we do like, within the long short equity space, managers that can perform intense fundamental analysis on small and mid-sized companies, given the dislocation that we've seen. They're finding a lot of interesting opportunities. Distressed credit is a space that we think could be very attractive over the next several quarters. And this is directly related to the dislocations that we're seeing and reading about today. And multi-strategy or event-driven managers. These would be managers that are generally very risk-sensitive. They're also very nimble and opportunistic. And if we do see dislocations in the credit markets, they can shift the portfolio and take advantage of those opportunities. And that doesn't have to even be debt. It could be from across the capital deck. It could be equity and other types of investments. So that, I mean, that's a key element there. It's not just the broad allocation into quote unquote alternatives and hedge funds. It's how you're using the managers and how much risk you want to take. Because if you want, you can use hedge funds in a way that significantly dials down risk.
So I think that brings our webinar to a close. I want to thank everyone for attending. We hope you found it interesting and insightful. We will continue to keep you updated on what's going on and our perspectives, particularly as we enter the election season. Stay well, and we look forward to speaking with you soon.